Visa processed 233 billion transactions last year. They have over 4 billion cards outstanding. Revenue, EBITDA, cash flow growing at double digits. If you bought the IPO, held it for the decade, it would have been up 500%. Let's pick this stock apart. Figure out, one, is it a good buy today? And then two, what lessons can we unpack from this absolute cash flow monster with 70% cash flow, 70% EBITDA margins? Let's dive right into this. Visa stock is an absolute monster. It processed 233 billion transactions last year with over 4.5 billion cards. Revenue, EBITDA, free cash flow are growing at double digits over the last 10 years. EBITDA margin is 70%. If you would have purchased at the IPO, held it for a decade, you made 5 times your money. Let's dive into this stock today, this absolute monster free cash flow machine, and figure out, is it a good buy? And then if it is or isn't, what lessons can we unpack from this stock for future investment decisions? You ready? Let's get to work. All right, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. My job here is to help unpack stocks for you. My professional gig, I'm a CFO for private equity companies. I've been running finance and operations for companies and corporate finance for over 15 years now. Did investment banking for 5 years, did lots of transactions, and I wanted to create a YouTube channel during the pandemic to help teach basic financial analysis to the masses. Voila, here's the channel. Let's dive in now and figure out, how do we evaluate stocks? We use 5 key factors. These are the factors I use at the board presentations when we're talking about buying other companies. We look for, number 1, top line revenue growth. Can you grow your top line revenue? Number 2, operating income. We use EBITDA here. EBITDA, enterprise level earnings. I don't care about earnings per share. I can manipulate that by the shares outstanding. I care, can the enterprise itself, regardless of shares outstanding, grow its operating income or grow its EBITDA. Number 3, strong free cash flow. Does that income translate to free cash flow? Is that enough to pay CapEx and other capital expenses? Number 4, low debt. I want to see less than 3 times debt to EBITDA ratio. That is a classic top tier leverage ratio. You know, the primary collateral is 3 times. You get more than 3 times, you get into junior, then you get into mezzanine, then you get preferred stock. Finally, you get your equity holders, which is you and I that buy stock. So we want less than 3 times debt to EBITDA ratio. And finally, the biggest factor, buy it at a reasonable price. We're all here to make money. We don't want to pay too much for a company. That determines what we make over the long run. But we don't want to be too cheap either, and that balance is very difficult to do. We strive here to at least explain how we do it. Let's dive into Visa and figure out what this stock made. I'm going to go right into the Cash Flow Club. You can find this at cashflowinvestingpro.com is the website. We run a program. It is a cash flow club. Join it, and we have analysts, myself, and others that publish, kind of like blog style, thoughts on individual stocks. Visa's one, and this week up, we're going to dive into Nathan stock. He's a CFA. Congrats, bro. Great job in getting the CFA. We're going to dive in and look at his analysis of Visa. He did this last year. His forecast was correct. He's doing it again this year. Let's dive in. All right, here we are, Visa, global payments company that facilitates over 200 in over 200 countries. With, here you go, 233 billion transactions processed in their network, cards, 2.5 billion. Here's the monster stat right near. It continues to capture a whopping 70% EBITDA margin. And like I said at the outset of the video here, EBITDA, adjusted free cash flow from operations and cash flow to equity, is growing at 11, 13, and 13% annually, respectively, over the last 10 years. CapEx is growing at a decent ratio, but still small compared to the earnings that the stock is receiving. They also are shrinking their outstanding shares. So that smells like a trifecta to me. If it's priced right, you got growing revenue, you've got growing earnings, you got shrinking shares outstanding, and if you can get cheap enough, you get that market multiple expansion, and you get the hockey stick curve that we talk about with the trifecta. Stock is currently trading at 26 times forward EBITDA. That's kind of a premium. The stock is pretty much always trading at a premium. The question is, how much of a premium? It's too much of a premium, I guess. Here's Nathan talking about his forecast earlier. He kind of nailed it. Great job. Awesome work. Thank you. He's a rising star here at the Cash Flow Club. We've got operating metrics, right? So U.S. payment growth. I want to show you one thing that we get in here before we go too far in. This chart right here is total credit card debt. It's flying around the internet. I see it on X all the time. 1.13 trillion in debt in 2020. Fourth quarter of 2023. That's even higher now. But debt is only an issue relative to income. So you really need to take a look at what overall income is. If I pull up, this is just total family debt by type from Motley Fool. Credit card debt, that $1 trillion here is this purple. You can see it's absolutely dwarfed by mortgage debt is the green. Home equity revolving lines of credit is in the yellow, blue is auto, and gray is other. So other household debt topping $15 trillion. Google says U.S. average American spends 11% of their income on debt. So 11% of debt would be this whole thing. The credit card number is relatively small. So you pick your battles here on how concerned you want to be about the overall debt level. It has to be geared to the income. And what I like about Visa and I liked about Mastercard when I bought them many years ago is that they make a small dollar amount, fractions, on millions, if not billions of transactions, or in this case, hundreds of billions of transactions. So there's really no customer concentration risk. You're making small pennies on just all transactions. And when you have something like inflation that moves up dollar amounts, you get a raise because you're getting a small percentage on a rising number, so your earnings are unaffected, and I think that's what we're seeing here. Here's the payment growth in nominal terms. Credit is Q1 of 2025, 6%. Debt 9, total is 7%. So they're still growing single top line levels. They're just also able through operating efficiency to squeeze out a little extra. That's how they get the double-digit earnings growth. Nathan does a great job running through a lot of the drivers, the breakdown of the business, card growth, dropping in all the metrics that we want to see. In terms of total assets, consolidated income statement, you can kind of see it all. And then what I wanted to get to right here is the cash flow one-pager where we summarize everything for you in a 10-year, easy, handy-dandy one-pager. If you're not a member of the club, it's $30 a month. You get a discount if you buy an annual membership. And I would propose this challenge to you. If you did join, did it for a year, I bet you would find at least one idea in there that's worth doing. And if you would have purchased it, it'd easily pay for the membership itself. Shameless plug, I know, but I had to do it. Let's take a look here. So Visa, let's start at revenue. In 2015, so a decade ago, when they IPO'd shortly there before, 13.8 billion. And I'm just going to read off the top line revenue numbers annually from 2015 to 2024. You got 13.8 billion, 15 billion, 18 billion, 20 billion, 22, 21. So there's down year there, which was COVID. Then rebound 24, 29, 32, 35. If I look at that in its totality over the 10 years on an annualized basis, that's 11% annual growth rate. That definitely checks the box on revenue. Let's check EBITDA. 9.6, 9.7 billion, 10.5, 13, 14, 16, 15, a little down year. 16.8, 20, 23, 25. 11% annual growth rate. So right there, you've got your EBITDA and revenue growth rates over the long term are the same percentage. That means margins are staying the same as they continue to track forward. let's smell check here for you. If we take the margin, $25.2 billion of EBITDA divided by revenue of 35.9, that gives me the 70%. Can you see that? 70% EBITDA margin. That is, let's just take a moment and just breathe that in for a second. That's astonishing. I thought Facebook was high or Meta was high at 40%. Nothing beats a credit card processor. Let's take a look at debt levels. So when they IPO'd, they had zero debt. They've issued some debt here to leverage the cash flow a little bit more. They're sitting at $20 billion of debt. But just looking at EBITDA at 25, we can skip over the debt to EBITDA ratio. That's less than 1. I would consider that practically zero debt. So from an equity perspective, if you're buying the stock and you think of the capital stack is basically how a company finances its operations. So you can, like I said, 0 to 3 times leverage is your first secured bond or leverage, like a mortgage on a house. That's your primary first secured asset. After that, you've got junior debt, so kind of like a cash flow loan, if you will. Number 3, you got mezzanine debt. Mezzanine just stands for hybrid between debt and equity. That sometimes comes with warrants, comes with convertibility. You're talking debt in the 15-18% interest range, so very expensive money. Then you've got your preferred equity. Preferred equity comes with typically a mandated coupon. You might not have to pay it, but it takes priority on cash flow over the coupon given to common stockholders. That preferred equity, again, gets a preferred return, sometimes has to get 1 or 2 times their money back before the value is released to the common stockholder. And then finally, behind all that is a common stockholder. That's you and me, the people buying the shares in the equity market. So think about that. If you're going into a company that's got leverage, certainly not just the primary first secured leverage, but it could have junior, could have mezzanine, could have preferred equity. All those stand in line in front of you. If you go to court and say, hey, I bought the stock, I want to sell the assets and get my money back, that is a big, big problem. So if you can, in this case, get a company that is very, very low leveraged, this is less than 1, that means none of these people are in your way, none of these people. You've got the common stock here is very close to the assets. That's a very good security position to be in, especially if a company is growing double digits like that and has low debt. Okay, and I digress. Debt, excess cash, $3.2 billion. Market cap, $571 billion, so $500 billion. It was $171 billion a decade ago, and it's continued to march forward. Enterprise value is basically the same here because debt's relatively low. So enterprise value, again, debt plus market cap less excess cash. What's interesting here is you get a little bit of a market multiple expansion. 17.5 is what it was trading for in 2015. Jumped up to 20 times, jumped to 25, then to 30, then back down to 20 in the kind of post-pandemic era. So you can kind of see a little bit of market multiple compression here. That's a big move. A 10 times market multiple compression. Look, it wiped out nearly $100 billion of market cap with this drop by 10x in the market multiple, despite the fact that EBITDA went from 16 billion to 20 billion. The market multiple compression here from 30 to 20 cut from $493 billion to $410 billion. That's roughly $80 billion of market cap went away like that, even though revenue and earnings still went up. That's the problem with paying too much for a stock. The business can outperform, but if you pay too much of a premium, you can still lose. So be careful. This market right now is extremely richly valued, I think practically by every metric possible: price to book, price to sales, price to earnings, price to forward earnings, price to free cash flow yield, all of those. The Case-Shiller ratio, the Buffett indicator, All of those are peaking at all-time highs right now in the S&P 500. So be careful what you're buying. Then it drops down, back down to what it's been sitting at normally. It's now at 23 times, a little high, but any place near 20, in my opinion, is a good deal for this business. That seems to be kind of a lower threshold where it really seemed to bottom out. Free cash flow here has followed EBITDA, 6.4 billion in 2015 to 5.4, 8.9, 12.6, 12, 10. It kind of dropped there a year in a row, $2 billion. 14 rebounded quickly, 18, 19, almost 20, and then 19. So last year came down a little. It can move up and down. It will move up and down as timing of cash receipts come in. It's not as smooth as EBITDA. But if you zoom out here and you look at the 13% long-term and the 11% long-term for EBITDA, those are going in the right direction. You want to see them going in the same direction. They are. That sounds like a good job in the accounting room. Here's your CapEx. CapEx is almost nothing. $1.2 billion reinvested on $19 billion of cash flow from operations. That's staggering. Think about it. You have $19 billion of jack at the end of the year. They're just piled up like this. And you're going to take 10% of that and say, oh, here, I'll go reinvest that back into the business. That's only 10%. You're still left with 90% of the free cash flow, of the earnings that turns into cash, 90% of that left over. Then you have to pay debt. Oh, yeah, I don't have to pay debt because debt's almost zero. It's very, very small. Last year they paid back zero debt. So that means that whole 19 or 18 billion right here is free cash flow to equity holders. That means it's you and me. That's what you're buying when you buy a stock. You're buying that number. You're just guessing at what that number is out in the future. That's the whole argument. That's everything in the stock market right there. It's simply a fight over what that number is going to be next year and the year following and the year following. That's it. That's the entire thing. Then you got shares outstanding, 2 billion shares outstanding. Look at them chew up shares. 2.4 billion, 2.4, 2.395, 2.29, 2.329, 2272, 2223, 21888. I mean, it just goes down, down, down every year. On average, 2% every single year. What that means is without you having to put a dime in the business, and you're not reinvesting anything, your ownership interest in this phenomenal company is growing. That's why buying back shares is so interesting, because you don't have to do anything. You don't have to buy more shares. You don't have to put more money out. But by them reaching into the market, buying shares out at the market price and tearing them up, that's taking the pie of shareholders and shrinking it. Think of a pizza pie and you have 8 slices. Take the same pie, you have 4 slices. Each slice just got bigger. Your ownership is a pie slice. If they tear up shares, your ownership in this fantastic company just gets bigger. That's why you buy and go live your life. You don't trade. Let the company, let the management do its thing. They are professional and they're managing your money for you. All you need to do, pick the right company, pick the right management team, make sure there's tailwinds for the industry that they're in, and make sure, hopefully, they're one of the best in that industry. And like I said, they've got the 5 key attributes, and let it ride. That's kind of the best case you can do, and walk away, give it a decade, and if you want to buy something else, go make more money and bring the cash flow and go buy the next stock. Don't trade. You're paying taxes. No. Free cash flow to equity per share, share price, and a yield. You'll see the yield 3%. That is a growth stock, 3-4%. That's kind of a growth stock. It's nothing like like a Nvidia or something like that. That's at less than 1%. So you're still making some money. There's a premium. Looks to me like the premium is justified. If we take a look at the forecast Nathan's got here, he's got 9% next year, a robust number. I think your risk here, right, is some sort of credit crunch from the tariffs that are coming in. There's some layoffs that I'm hearing. I'm starting to smell kind of the whiff of layoffs in some of the companies that I run and manage. I interact with suppliers and vendors, and I'm I'm hearing some rumblings of people that have been laid off. And so I do want to caution you that there could be a surprise coming in 2025 as like the tariffs bite. We've got cuts going on in the federal government. The federal budget right now, that deficit spending that they're doing, it's around 6% of the federal budget. That is an expansionary fiscal policy. If they cut back, if Doge cut back the government, that is a contractionary fiscal policy, and that is going to be restrictive on the economy, even if long-term getting our debt under control is an excellent thing. It could mean short-term pain. Short-term pain at an all-time high market multiple could be a problem if that market multiple collapses, like we see here from 30 to 20. You could lose that $10 billion, the $100 billion market cap that I was referencing was basically 20% of the market, like that. So be careful out there. But I digress. 9%, he's just bringing down the growth forecast, right? They've been growing for double digit over a decade. This says, hey, long term, I'm going to grow at 5.5% annually. Okay, we could have 3% inflation, 4% inflation for quite some time as they monetize the debt. So that's really nominal, that's really real growth of 2 to 4% over time. That's okay. We can continue doing that, maybe. If you believe that forecast, then you've got $48 billion of EBITDA out 10 years as your like long-term guess at the future, swag, if, forecast. He's got 20 times market multiple. I think it's a conservative market multiple. That's where you want to be buying it at. He's not relying on a market multiple expansion, so this is not a trifecta opportunity currently. If you can buy it for less than 20 times EBITDA, then it would become a trifecta opportunity. But that basically says, hey, I've got a $460 price target out long term on this stock. If we do a free cash flow basis, take that free cash flow, same growth rate, you're looking at just shy of $19 per share of free cash that you can argue over is someplace in the future. You apply a 4% free cash flow yield to that, you get a $450 stock price. We average the two, and we get our handy-dandy IRR calculation down here at the bottom. This is saying, hey, I get this stream of cash flow. It's not a dividend. It's not paid out to you. It's your pro rata ownership in this company. Some of it you're going to get as a dividend. Some of it's going to be given to you as a stock buyback. We assume stocks are constant, shares are constant, and we just pay it out as an illustration to come up with the IRR. Then you buy the stock at $353, you sell at $455. That's a 7% IRR. That is below our target of 10%, which is typically what the market will do, blah, blah, blah. But you can set your whatever the level is that you want. It's your own hurdle rate. What does your money cost you? I hear people use WACC all the time, the weighted average cost of capital. That's something you use within a company if you're making capital decisions within a company. As a CFO, I use WACC all the time to figure out, is it worth buying something? What's my cost of capital? What's my arbitrage? That's fine. But for you as an investor, you want to set a hurdle rate because it's your own money. It's your cost of capital. How hard did you work for that money? How many years did you sweat away to save it? So your IRR, your cost of capital, your discount rate, your cost of capital should be meaningful to you. I say, hey, let's just segment by the market, 10%. I want to beat the market, so I want a little more north of that. Here at 7%, I think that is this is a tricky stock. It typically trades at a premium. There are times when I did not buy this stock because it was trading at a premium, and I thought, well, I'll wait for it to come down, and it never came down. This might be a stock where, you get a once every decade opportunity to buy it. You can see in 2022, it was 21 times EBITDA. That's the cheapest it's been in 8 years. So if it's around 20x, you might want to consider picking this one up. Right now, it looks like you'd want to hold off and wait, especially if we get some kind of credit crisis. This is a phenomenal stock to go into when you're in a credit crisis or kind of dipping into and the market freaks out. That's the time to say, I'm going to hold this thing for 10, 20 years. I'm going to gift it to my children, and I'm going to hang on to this stock. So, Nathan, thanks so much for doing the write-up. This is in the Cash Flow Club. You can check out You can check out our work at cashflowinvestingpro.com. Let's recap the 5 key attributes on this stock. Visa, number 1, top line revenue growth. Yes, it's growing at double digit. EBITDA, enterprise level earnings, growing. Free cash flow, it is very, very strong. Very strong. Low debt, debt's less than 1. It's almost a goose egg. Great job, CFO, for keeping that debt under control. Love to see that. Love to see that. And finally, is it well priced? I'm going to say no, because my hurdle rate is the market return of 10%. It could be for you if you want to get in the stock because you want to add it. But I think no. I think you wait. If we get a credit crisis or some sort of issue, this is definitely a stock that would take a hit if default rates start spiking. And at that time, I would seriously look at this. So what I would do is jump in, sign up for the Cash Flow Club, go into the Nathan's article, give him a big smashed thumbs up, print this out, keep it on your desk, and once every 6 months, pick it up and look at it. Say, oh, that's right. I want 20 times EBITDA. Look at it on Yahoo or set your price target alerts or whatever. If it hits 20, you might want to consider this stock. All right, that's rational investing. This is Visa. Late in the evening, filming. Need to go to bed. Got a big day tomorrow. Thank you so much for watching. I really, really appreciate the channel and all the subscribers, all the support. I'm going to continue to crank out content, do more forums. I want to do another live here shortly. Throw me a like, comment down below. It always helps the algorithm. I'm trying to grow my Facebook account, so if you want to flip over to the Cash Flow Club on Facebook, sign up for there. That'd be fantastic. And give me a comment. Let me know, what do you want to see? What stock should I do next? I like big, large cap stocks. It's just easier to run the numbers. They get more searches on YouTube. So, give me a good one. I was looking into the gold stocks, and I was kind of going back to see old analysis that I did. I thought where they would be, and surprisingly, they've underperformed on an EBITDA basis from what I thought they would do. I still think it's a very interesting play if gold continues to run. But let's find some big monster stocks. We did ASML not too long ago. That was a great stock. Got lots of comments on the Heinz stock. Looked at that one. That's definitely a lesson of what not to buy. You want to check that video out. And of course, the Facebook stock, the Meta, is just an absolute beast. But let me know what else you want to see. I appreciate the time. Thank you very much. Bye-bye.